Good afternoon, everybody, and welcome to our webinar on ESMA and the future of European ETFs. This webinar is sponsored by Lyxor, and indexuniverse.eu is responsible for the content and the slides that you'll see coming up. My name is Paul Amery. I'm the editor of indexuniverse.eu and the Journal of Indexes Europe, and I'm joined on today's webinar by three speakers. Alain Dubois is chairman of Lyxor Asset Management. Roy Zimmerhansl is owner of FinTuition and Zimmerhansl Consulting Services. And Frédéric Ducoulombier is director of the EDHEC Risk Institute Asia and is based in Singapore. A reminder before we move on to the agenda and the webinar content, it's to all of you listening in, it's very easy to submit a question, and you are free to do so at any time during the next hour. All you have to do is to type your question into the question and answer window on the lower right-hand corner of your screen. Click the send button. I will collect your questions and pass them on to the panelists. For the first part of the webinar, I'm going to run through a summary of what is included in the European Securities and Markets Authority, the Europe-wide Securities Market Regulator's recent consultation paper on ETFs and other UCITS. We've broken it down into categories which broadly follow the categories as set out in ESMA's paper. So we're going to be looking at collateral and counterparties, tradability, strategy indices, other disclosures, the timeline for the consultation, and then we'd like to open it up to a debate with our panelists on some of these individual issues, but also a broader debate about the future of the European ETF market. So let's look first of all at what is covered by ESMA and its consultation paper. First of all, there's been a broadening of scope since the discussion paper of July 2011 was released. That was entitled UCITS Exchange Traded Funds and Structured UCITS. Now they've entitled their consultation paper ETFs and Other UCITS. And in an interview that I did with some representatives of ESMA last week, they were clear about the fact that they realized that they had some of the topics they were raising relating to so-called efficient portfolio management techniques like securities lending, the use of total return swaps in UCITS funds, or the disclosure requirements in general were not ETF-specific issues but had to be addressed in the context of the whole of UCITS. So they've made some changes to the scope of their guidelines and are now addressing UCITS more broadly, of which ETFs are clearly a part, or most ETFs in Europe are a part. One of the things that ESMA is now suggesting should take place is that any ETF, exchange-traded fund in Europe, which fits into the UCITS framework, should have an identifier, and the identifier is ETF, and in order to qualify for that identifier, they're setting some fairly minimal formal requirements. In other words, that the ETF has to be continuously tradable on at least one regulated market or MTF, with at least one market maker that ensures that the value of the ETF doesn't deviate significantly from the net asset value of the funds. So that's the ESMA definition of an ETF. So what is not covered? Well, first of all, anything that is not a UCITS fund is not covered. So things that investment products that are not funds, for example, like exchange-traded notes, exchange-traded commodities, other exchange-traded products are not covered by this consultation. And other types of funds on sale in Europe, for example, those that are under the Alternative Investment Fund Managers Directive, which is largely addressed at hedge funds and alternatives, are not covered by this consultation. Having said that, ESMA, again in its interview with us last week, which is published on our website, they've said that they realize that there is a need to harmonize regulation across different types of investment products, and this is a longer-term objective, so that they're talking about the need for a cross-sectoral approach to cover not just UCITS funds but other investment products, and that has to be undertaken at the level of the European Commission. So that's a longer-term objective that they're still thinking about. One of the things that ESMA first mentions in its discussion, in its consultation paper, is that it's concerned by what they call the retailization of complex products. Now, it's worth remembering that by their original design, UCITS funds were automatically considered to be non-complex because this was the standard type of fund aimed at distribution to the broad retail market in Europe. Now, there's an ongoing European Commission review of the Markets in Financial Instruments Directive, also known as MiFID or MiFID II, referring to the review. There's a possibility that so-called structured UCITS may be removed from a non-complex category and therefore classified as a complex type of investment product, which would be subject to additional appropriateness tests by any financial intermediary before an investor in Europe could buy that particular product without having additional investment advice. That's still subject to debate, and ESMA refers to this in its consultation paper. The final decision on this topic will be made by MiFID II, which is due, people are saying, probably sometime later this year or in 2013. So what's the overlap there with UCITS and ETFs? Well, structured UCITS, the category that the MiFID II review in its draft version is referring to, is a type of UCITS which provides investors with algorithm-based payoffs linked to the performance of financial assets, indices, or reference portfolios, or UCITS with similar features. It's not clear that this in any way overlaps with the category of synthetic ETFs using derivatives. And in fact, when we queried this with ESMA in our interview last week, they said that at first glance that those categories are not identical. So it seems that well, clearly ESMA at this point is not drawing a dividing line between different types of ETF, between physically replicated ETFs and synthetic ETFs. But this is clearly a debate that we should still follow, and I'd be interested in hearing Alain's views on this in particular. It's also worth mentioning that some national regulators, for example, the UK's Financial Services Authority, did say last year that the distribution of synthetic ETFs to retail investors should be restricted. So that, even though ESMA at this point, and it looks very unlikely that ESMA would draw any dividing lines through the ETF market, there is this definition of structured UCITS, which the European Commission may decide to deem as complex in due course. Let's look at the collateral and counterparty exposures within UCITS and obviously also within ETFs, and how ESMA is proposing to change the regulations in this area. What's at issue? Well, within the ETF market specifically, and not just not UCITS as a whole, but in the ETF market in particular, and arguably this part of the market has led the debate for all UCITS. Since 2008, a lot of investors and commentators, ourselves included, have been focusing on collateral exposures, counterparty risks, and people have been debating at length whether some structures are inherently riskier than others. ESMA in its guidelines, I think, is clearly aiming to achieve some consistency both across different types of ETF product structures, but also across UCITS as a whole, because it's important to remember that a lot of UCITS funds that are not ETFs also incur some of the same collateral and counterparty exposures. I think this is a point that we've added, Index Universe. We've picked up, and maybe this is just our interpretation, but we feel that the regulators are looking more broadly at possible conflicts of interest in European fund structures, and there one might compare the fund rules in the US and the US 1940 Act, which regulates investment funds, where dealing with affiliates is not allowed as a first principle. You have to then apply for an exemption in order to do so. European regulations don't have that specification, but perhaps the regulator is looking at this as a longer term project. But any changes there would have to be done, I think, at a UCITS level. They would certainly not just be anything to do with ETFs. So let's look at the collateral and counterparty questions in a little bit more detail. First of all, let's deal with securities lending and what the regulator is suggesting. Well, what they call efficient portfolio management refers to securities lending, repo and reverse repo operations undertaken by UCITS funds. And in the consultation paper, ESMA says that we consider it important to impose additional requirements on UCITS that make use of these techniques, particularly with respect to collateral. So what are they saying? Well, these are their draft guidelines. The first point sounds a bit technical, but what it basically means is that they're planning to impose the same collateral guidelines when securities lending is undertaken by a fund as exist for funds using over-the-counter derivatives or swaps. And those CESR or CESR, which was the forerunner of ESMA, those guidelines which were published in 2010, essentially set out principles for how liquid collateral should be, how it should be valued, the credit quality of the issuer of the collateral, also some principles on correlation, and also using third-party custodians. The second bullet point is a notable one, that they're saying that fees arising from so-called EPM techniques, so securities lending revenues, should as a general rule be returned to the fund. Now currently many ETF managers split their revenues from securities lending, in some cases 50-50, in some cases 40 to the manager, 60 to the fund with investors. Other non-ETF funds, I've heard some of them even retain all the revenues for the manager and don't give any of the lending revenues to the fund investors. So ESMA is saying, well, this has to change. As a general rule, the revenues after costs of running the operation should be returned to the investors. So I'd be interested to hear our panelists' views on what this is going to mean for UCITS and ETFs in particular. The reinvestment of cash collateral in so-called non-risk-free assets will no longer be permitted. You'll have to disclose any affiliated third-party lending agents. ESMA is also suggesting bringing in quantitative limits on lending, so how much of a fund's assets may be lent out. Currently, you can lend out up to 100% of a UCITS fund's portfolio. That may have to be reduced, and they may do it either at the overall portfolio level or by counterparty. And they're also asking people to give their views on whether the collateral should be highly liquid or highly correlated. When it comes to the use of derivatives by UCITS, in the ETF market, the majority of funds in Europe are based upon this structure, where a derivative contract is used to provide the index return for investors, but total return swaps are used by many other types of UCITS, including long-short funds, absolute return funds, funds offering some kind of arbitrage or predefined payoff. So the key points raised by ESMA in its consultation paper, the first one, if a UCITS fund is investing in a swap that gives exposure to an index, but buying another basket of investments, they're asking, does the index need to be, or do the underlying investments need to be diversified in accordance with the same rules as the index? And here we've understood that there have been some differences in the past in the way national regulators have interpreted this. So they're saying, yes, I'll come on to this on the next page, but they're basically saying, yes, you should have diversification at both levels. They're also asking if the swap counterparty has some element of control over the fund's investment decisions, what should be done? And they are asking, the regulators are asking whether investors are informed about the possible impact of a counterparty's default, what might happen in that case. So these are the draft guidelines they've put into the consultation paper. The first point I've just mentioned, they're saying yes, both the underlying portfolio whose returns are swapped in a synthetic ETF and the index being tracked must meet the relevant diversification rules. And for a UCITS using funded swaps, the collateral taken as part of the funded swap structure must also meet the diversification rules. You have to document your haircut policy for collateral, and the UCITS prospectus, the fund prospectus, must detail information on the index strategy, composition, counterparties, and the effect of a default on an investor. And finally, if the counterparty to the swap has any kind of discretion over what gets given to the fund effectively, that counterparty must be treated as an investment manager. On disclosures for both securities lending and use of derivatives, ESMA is suggesting that the following things have to be disclosed on an annual basis in the report on accounts. So exposures, identity of counterparties, and the type and amount of collateral received. They also say that best practice should be to disclose more frequently. Well, it's clear that particularly in the ETF market, this falls well short of current ETF market practice, since most providers of synthetic ETFs disclose this information on a daily basis, and a lot of them have changed to disclose that over the last year or two. And some physical ETF providers of physical ETFs are have started to disclose details of their lending operations. So ESMA is not suggesting that that frequency of disclosure should be mandatory. Perhaps they're bearing in mind other types of UCITS that haven't had to do this at all, but I'll be interested to hear our panelists' views on this subject. Let's move on to tradability. Here ESMA is saying that investors in UCITS exchange-traded funds need to have a specific risk warning about the possibility of trading at a premium or discount to NAV. And it seems from the consultation paper that more responsibility is being placed on the ETF issuer to ensure that the funds they issue are tradable. And currently, you could argue that this is our interpretation, but we think that the responsibilities for ETF liquidity are rather blurred because you have official market makers for a fund that sign up to obligations with stock exchanges on which the funds are listed, typically to quote for a minimum percentage of the trading day and within a maximum spread band. There are lots of other market makers who don't have any official status but trade in offer that do quote prices in ETFs and therefore support liquidity in practice. Issuers have agreements with the authorized participants who create their funds, and there's an overlap between the authorized participant category and official market makers. In many cases, they're the same firms. And issuers have in some cases, do have contractual obligations with market makers, or at least monitor their performance. So those are the existing, let's say, support mechanisms for liquidity. But it seems to us that ESMA is putting more emphasis on the issuer's responsibility in all this, because currently several types of bodies are involved in tradability. So this is what the regulators put into the draft guidelines. First of all, there are two options basically that they're asking people to choose between. First of all, the management company should ensure that market makers offer redemption when the secondary market is open. If they can't do so, then the management company should, or the UCITS manager should take appropriate action to replace the market maker and should ensure the protection of unit holders in the interim, for example, by allowing people to redeem directly. And they're also saying that there should be a specific risk warning about possibility of trading at a premium or discount. Option 2 is to allow investors to redeem ETFs directly with the issuer. This would mean a substantial change in business models from the existing ETF structure, because as things stand, I think the whole point of ETFs is that they are only created and redeemed by these intermediaries called authorized participants. If you had thousands or tens of thousands of investors starting to redeem directly, a whole new set of structures would have to be invented. So again, I'd be interested to hear panelists' views on this. Strategy indices is a key section of the ESMA paper. They define this as a strategy index is an index which aims at replicating a quantitative strategy or a trading strategy, can be based on a proprietary model developed by the index manager. Now, a reminder of the rules about financial indices and the types of index that a fund may gain exposure to via a derivative. The current rules say that the index has to be sufficiently diversified, and that's typically a 20% maximum exposure to any one issuer, which can in certain cases be increased to 35%. The benchmark has to be adequate, and the index has to be published in an appropriate manner. So ESMA is now saying that in order for strategy indices to be, in other words, indices that embed some kind of investment strategy, to be acceptable as financial indices and therefore tracked by a derivatives contract, there needs to be more guidance to investors and greater disclosures are needed. And if index providers don't do this, then they won't be able to use, or their indices will not be able to be used anymore for funds that use derivatives to track them. So these are the draft guidelines in the consultation paper. I think the first point is probably one we can skip over, but they're saying that the strategy indices should have a clear single objective. There should be a clear index universe and selection criteria. The rebalancing frequency should not prevent investors from being able to replicate the index. So they say that intraday or daily rebalancing, for example, would be unsuitable. It's worth pointing out that it's unclear how that, at least in our reading, how that leaves the existing category of inverse and leveraged ETFs that do rebalance their indices daily. So I think we'd like to understand that one a bit better. On transparency of the index methodology, the ESMA is saying that the index providers should disclose constituents, the index calculation and rebalancing methodologies, any index changes, and the index's performance via the internet. So that, I think, is going further than current market practice, and that's an interesting one in terms of index providers' business models. Other changes they're suggesting, or other rules they want to introduce: you can't have any payment from a index constituent for inclusion. You can't change indices retrospectively. The fund or the fund's manager has to carry out a due diligence process on the quality of the index. There must be an independent assessment of the swap's valuation if the swap is involved, and the index itself must be independently valued. A couple of other disclosures that I'll mention but won't spend time on. There are some requirements for actively managed UCITS ETFs, that they should be separately identified, and how the outperformance or the proposed outperformance is meant to be achieved, and some guidance on fund transparency, in particular where you find the intraday fund value. Tracking error, they've moved from one definition in the discussion paper to I think a more standard definition of tracking error, which is the variability of the fund's return against this benchmark, rather than an absolute tracking error or tracking distance, which some people call it, which was the definition they used in the discussion paper. And on leveraged funds, they are asking for some additional disclosures. This is the regulatory timeline from here on outwards. Also, we've shown that the last couple of years of history. So we've gone in blue. You can see the ESMA discussion papers and consultation papers as they affect ETFs. The discussion paper came in the summer last year. We just had the consultation paper released. People can submit their responses to the consultation paper by the 30th of March, so there's still a month and a half or so to go for anyone to send in their thoughts on what ESMA is proposing, and the final guidelines will be issued in June, probably this year. MiFID II, the European Commission's review of market structure in Europe, is still ongoing. The draft proposal has been for the revised MiFID has been released. Came out late last year, but there's still some period of consultation before the final version takes effect, and some people are saying 2013. One or two people are saying it might take even longer for that to take place. It's worth mentioning, we haven't done it on this chart, that there are other regulatory initiatives that are going to affect the fund management business. EMIR, the regulation of derivatives and the clearing and settlement of over-the-counter derivatives, is also going on in parallel, and may have an important impact on our small sector of the market. And that's, I think, is the timeline for that. We haven't indicated here, but I think that's probably likely to arrive at a conclusion later this year. So how is this all going to affect European ETFs? Well, clearly the regulator ESMA has moved beyond seeing ETFs as a separate issue, and now they're saying that, understandably, that ETFs have to be treated in the context of the overall UCITS rules, and so they're approaching UCITS funds more broadly. I think for investors and those of us following the ETF market, the emphasis should therefore turn to ensuring, or to trying to compare ETFs and other UCITS funds, both in terms of their investment objectives, their performance, their costs, and some of these ancillary activities and associated risks that people have been talking about in the ETF market, but they affect other funds as well. So I think there's a much broader debate about the future of the funds business going on, and I'll be interested to hear people's thoughts on how ETFs are going to fit into that funds business in Europe in future. Clearly, ETFs, based upon last year's fund figures, even though the growth rate of the European ETF market slowed down, they continue to gain market share at the expense of other funds. The cross-sectoral initiative that ESMA refers to, covering other types of funds and other non-fund investment products, is definitely needed, but it may take several years. And as a last point, this is something we put in. I think we've seen ETFs beginning to encroach on the active fund management for example, via strategy indices. So that's another interesting trend that's going on. At this point, I'll turn to our panelists and ask them to share their views. A reminder to everybody listening in to please send in your questions in the Q&A box. You can send them in at any time, and I will pass them on to our panelists. Perhaps, Alain, I could start with you. What are your thoughts on the ESMA consultation paper and on how the regulators' thinking has evolved since this whole process started last summer?
Yes, thank you. The first thing to say, which seems to me extremely important, is that ESMA is, most of you know that, I guess, but ESMA is the European authority in charge of regulating asset management. Now, there have been a lot of reports, there have been a lot of declarations concerning ETFs, but at the end of it, ESMA decides. And what is very important about this consultation, it seems to me, is that it is very likely to, I would say, tone down the debate about the dangers of some sort of replication techniques. And I would even say that this consultation in many ways validates our synthetic model. ESMA has completely examined the issues and seems to have arrived at very simple conclusions. First, there is no need of some specific ETF regulation. I mean, there is only one very marginal regulation that concerns ETFs per se in this consultation. Most of what is proposed concerns UCITS in general and not specifically ETFs. So this is something that we have always said. ETFs are only UCITS, nothing less, nothing more. And all the regulatory move that could happen should happen in the UCITS world. And this is exactly what has happened. And also the second point is that ESMA arrived at the conclusion that only limited adaptations of current regulations were really needed. I mean, there is nothing here revolutionary. There are only limited adaptations that go in the right direction, it seems to us. But this is not something that is a fundamental change. And when you think at it, this is very understandable, because ESMA is the successor of CESR, and CESR has very much improved the UCITS framework over time, with UCITS 4, with all the new guidelines that have happened in 2010, for example. So I don't see why they would completely change something that has worked for so long.
Alain, can I ask you a question at that point? Clearly the regulator has, they decided there will be no dividing line drawn down the ETF market or the UCITS market in general. These are all UCITS funds. But what about the question of different business models in Europe? Because there are some, let's say, in the ETF market we see it very clearly. There is the asset management type ETF model. With firms coming from that sector, and there's the investment bank-driven model, which tends to be the synthetic ETF model. Is the regulator going to do anything, do you think, about, or are they going to take any position on whether fund management firms should follow a so-called vertical model or horizontal model, whether there should be any restrictions on dealing with affiliated firms, whether that's an affiliated lending agent or an affiliated counterparty or custodian? What do you think they might do here?
Well, these debates are not about how the UCITS regulation is in Europe. UCITS regulation don't work this way. ETFs are UCITS, and UCITS are managed by independent asset managers. This is how it is working. So I think that this debate is not in line with how the regulations are built in Europe. And UCITS, is not a new directive. UCITS exists since a long time, so there is a lot of background about that. Maybe I would like to point out to some very important things that you did not mention in your presentations, because it seems to me there are two major things in these proposals. One is some sort of level playing field. Between securities lending and derivatives. One of the major decisions that they propose is to extend the regulation of collateral of derivatives to the collateral of securities lending operations. This is one major decision that is likely to create a level playing field in Europe. concerning the two type of exposures. We have always explained that in many respects, synthetic structures were only a variant of securities lending operations, and this confirms very much this point. And the second point that you didn't mention in your presentation is the tracking error. You mentioned it a little bit, but I think it's quite important because this consultation proposes a full transparency of the tracking error for the first time. You know, we have always thought that one of the major points for investors, after all, their main risk when they invest in an ETF is that they invest in a fund that doesn't replicate the index that it is supposed to replicate. So we believe that it's very important to have strong tracking error regulations where you would have at the same time some target tracking error and some transparency of the effective tracking error.
Okay.
These are two measures I would like. Yes, sorry.
Yes, we did talk about the harmonization of the collateral requirements for sec lending and for bringing them in line to the ones that exist for derivatives. I'd like to bring Roy in at that point because Roy, I've heard you talk on this subject in the past. I mean, perhaps I could ask you about that specific proposed rule change about harmonizing collateral requirements and whether you think it makes sense. And more broadly, if I could ask you what your thoughts are on the consultation paper.
Okay, thanks for that. Let me start with, I guess, a couple of points. I would agree with Alain that in terms of the commonality between the securities lending and derivative sort of risk exposures, I've always argued that they're very much the same. So whether that's counterparty or collateral or market risk, it's experienced by both the physical ETFs that lend and the derivative structures of the different types. So I think at a headline level, it certainly makes sense. I think where there's an issue now, though, is that the concept of bringing in harmonization between securities lending and derivative collateral then all of a sudden places a different barrier between securities lending of UCITS and securities lending as practiced by just about every other institutional investor, because the standards for the derivative collateral is different. And I think there's a reason why they may be different in the sense that the overwhelming majority of the securities lending transactions are open transactions that are closed out without penalty, that are repriced, re-rated. There's a number of different structures or different features, I think, that apply to securities lending, which means that as a securities lending transaction, it's not directly comparable to most derivative transactions, which might have fixed terms, fixed structures, penalties for early closeouts, those sorts of things. So I don't think it's necessarily directly exactly the same, similar risks, but not the same. So I would say that having exactly the same collateral profiles would be inappropriate, and if that was actually implemented across UCITS, would disadvantage UCITS funds to the advantage of other lenders.
Okay, that's quite a technical point. I think we'll be hearing more from some of the people responding to the consultation paper. What are your general thoughts on the orientation of the regulator in the consultation paper?
Yeah, I mean, generally speaking, there are a number of sort of real positives. I think, in terms of disclosure and transparency, that's generally a good thing. And I think in this case, with respect to ETFs, the synthetics have really been leading the charge on this and actually forcing the physical-backed ones to increase their standards. So I think you mentioned earlier, Paul, that increasing disclosure on the part of a few of the ETF issuers on the physical side. I think it's inevitable that it not only drives the remaining physical ETF providers, but probably will have a wider impact across a number of different fund types in improving the disclosures. So I think, generally speaking, that's quite a good thing. I think there are situations where it's less good. So let me give you an example of that. So on the collateral side of things, all of a sudden, you have a mixture of objectives. So yeah, I don't think anyone's going to argue with the fact that liquid and diversified, unconcentrated collateral pools is a good idea. I think it's a good idea that you don't have related entity collateral. So again, all of those things make sense. One of my questions, though, is the true value of actually disclosure of the underlying collateral positions. Just saying that Fund A is holding a collateral pool that looks like this, I think, is a challenging issue. So you want to talk about technical questions. I think if you talk to any group of professionals within the collateral management business, you will get different debates on what's good quality collateral, what isn't good quality collateral, what's appropriate collateral for a given transaction. So I think it's as likely to raise as many questions as it will answer. So yeah, I think the jury's still out on that issue.
Yeah. Well, sorry.
Yeah,
go ahead.
Yes, is that you, Frédéric?
No, that was Alain. Sorry.
Alain, sorry. Please.
I just wanted to say that the transparency of the collateral is useful for investors. You know, we have seen, I mean, we are posting every day on our website the collateral of all our funds, and I think it's quite important to do that because it matters to investors. For example, we have seen some ETFs that are indexed on government bonds, on European government bonds, where the collateral is something like equity of Spanish banks, for example. So it clearly matters to investors who invest in this type of a product to know that in the event of a bankruptcy of a counterparty, they will be left with some Spanish equities and not with government bonds. So I think it matters very much.
Sure, but I think the counterpoint to that is, and I've done models where at actual times of defaults by counterparties, entities would have been better off holding equities as collateral in some instances, government bonds as collateral in other instances, and cash in other instances. So while I think you've made a reasonable point there, if I thought I had a government bond ETF and I end up holding a bunch of equities, I would want to know that. My point here, though, is I'm not convinced that everyone is properly positioned to assess whether that's good collateral or not.
Right? I think this is a very interesting subject, and I think we could probably hold a webinar on this particular issue itself. But I'd like to bring in Frédéric at this point and ask you a couple of things. Frédéric, first of all, your general thoughts on the consultation paper, but I also noted that EDHEC Risk came out with some comments very soon after the consultation paper was released on index transparency, and in particular you thought that the regulators hadn't gone far enough. So I'd like you to explain to us all why you thought that, or why you think that.
Well, first, we welcome the broad focus of the new consultation. The issues are approached. Can you hear me? Yes.
Yep.
Yes, sir. Are approached in a horizontal way, and this provides for a much better chance of reaching a level playing field across UCITS. And we've also seen an important shift whereby ESMA looks at the underlying risks as opposed to focusing on techniques that are used for replication, for example. So these new guidelines are consistent with our recommendations that counterparty risk be approached in a consistent way by recognizing, as you said, that it can arise in different ways via OTC derivatives, but also through securities lending operations, and by recommending that the same standards apply. So we do support that the application of the same limits in terms of counterparty risk across the board. We do support industry-wide standards of transparency, and I do believe, just like Alain said, that it is good for the investors to know what collateral is posted, and whether or not they are equipped to correctly use this information. At least the information is provided, and CESR investors can do their due diligences. So this is very welcome, I think. As you mentioned, the requirements are across UCITS and are not too stringent when you look at the actual current practices in the ETF segment, but this is something we may be coming back later on. One thing we were cautious about was this idea that different replication techniques called for different identifiers, and clearly the ESMA has avoided this error of recommending the use of identifiers that would have been based on the engineering methods. We really think that any identification should be related to the underlying risks of the funds. Yeah, so in terms of where it could have been better, it is good that the ESMA chooses to underline, to require that actively managed ETFs underline in their marketing material and in their prospectus that they are actively managed. Unfortunately, what we find that there is no clear definition of what is an actively or a passively managed fund in the current consultation, since there has been no maximum tracking error limit defined. So that's, I think this is something there's room for further improvement. Now, in terms of transparency, yes, we released comments on the ESMA new consultation paper, and we regretted that the ESMA fell short of requiring that the constituents and all the information allowing investors to assess the risks of the indices be provided free of charge to investors. There is a requirement that this be available, but there is no requirement that this be made available free of charge.
Okay. Well, Alain, what's your view on that question of index transparency, and what's been your experience as an ETF provider in how willing the index providers are to allow you, for example, to disclose constituents of the benchmark your funds are tracking?
Well, if I may, this is not an ETF issue, in fact. This issue of strategy indices is an issue of so-called UCITS. Of so-called hedge funds that are wrapped in a UCITS format. Many of this structure use strategy indices. So this is something that is directed more at this UCITS business than at the ETF business. The ETF business will not be impacted at all by that.
But there are some ETFs that do follow strategy indices, aren't there?
Yes, but they are strategy indices. They are just managed, actively managed ETF, I would say, which are exposed on an index. So I don't see any issue there. You can just consider this type of ETFs as actively managed indices, actively managed ETFs, and the underlying is an index. So you can do a leverage of 2 on an index according to UCITS regulation, so there is no issue here. So no, I don't think it will have any impact on leverage ETFs.
I see. Alain, there's a question I would like to ask you that's coming from one of our participants. Is it not too soon to say that ESMA has decided not to split UCITS into 2? It seems to be that that idea is still very much out there, but it's just moved to the MiFID II debate. What's your take on that?
Well, I think there have been a lot of things that have been said that are not correct. I mean, we fully support the splitting of the UCITS world between simple UCITS and complex UCITS, and many regulators support that, but never has ETF been likely to be considered as complex. The proposal of the EU Commission, for example, is to consider as complex structured UCITS. But ETFs are absolutely not structured UCITS, and it has never been questioned that they are not structured UCITS. The notion of structured UCITS is very well defined under European law. It is so well defined that structured UCITS have a special treatment for the key investors information document. they have a specific KID with 3 pages instead of 2. Structured UCITS are funds with a predetermined payoff. It has absolutely nothing to do with ETFs whatsoever. So the idea that you should have some simple UCITS and some complex UCITS, it seems to me makes sense, but I don't think there has been any question of considering ETFs as complex.
So you're saying that there may be some division within UCITS, but it's not going to affect ETFs?
Exactly, exactly.
Okay.
At least it will not affect ETFs that are indexed on market indices. I mean, whether it could affect, I don't know, an ETF which is indexed, for example, on a hedge fund index, maybe it could.
Right.
If they extend the definition of complexity to the so-called UCITS world, as some regulators wish to do, but there has never been any question by any regulator, as far as I know, where they would consider an ETF that is indexed, I don't know, on the Eurostoxx 50 or on the MSCI world as a complex UCITS. You know, we should never forget that this notion of simple and complex is a notion which is linked to marketing. This is linked to MiFID and marketing. The only difference between a fund that is simple and complex, between a financial product that is simple and complex, is that when you market a complex product, you must make sure that the investors understand the risk. This is the appropriateness test.
Okay.
So this is based on the capacity of investors to understand the risk. But when they just invest in an ETF which is indexed on a market index, I mean, they understand that it's indexed on a market index, that it goes up if the index goes up and down if the index goes down. So they understand the basic risk. So we don't expect any risk in this respect.
Okay. Roy, I'd like to ask you about the extent to which this particular bit of regulation fits into some of the broader concerns that have been expressed by international regulators over the last year about collateral swaps, liquidity swaps, people exchanging less liquid or more liquid collateral for less liquid collateral, and the extent to which that might be contributing to risks more broadly within the financial system. What's your take on that more general subject?
Yeah, well, I think you've hit the nail on the head. You know, it's a broader context of everything. We did a count a couple of weeks ago, and there were at least 15 different regulatory inquiries into that deal, at least in part with collateral. So probably the most imminent example is in the UK, for instance. The FSA has been looking at the issue of collateral swaps or collateral upgrade trades or liquidity swaps or collateral transformations, take your pick of labels. And I think what everyone's trying to do right now is examine the issue in terms of the fixed nature of the transactions versus the liquidity of the underlying collateral. So I think that's probably the one common theme there. But in the example, for instance, that we heard earlier in the call here, where we were talking about swapping effectively a government bond portfolio for equities as collateral, that's a common part of the market today. That's certainly something that I believe the FSA will be commenting on. And I think that this is an example where if you just took ETFs out of the picture and said, look, anyone that's doing an ETF, the collateral that is supporting that transaction, whether it's synthetic or whether it's actually the physical, has to have fully correlated assets. Well, frankly, that's just not possible in the transaction. You can have similar correlation, but if you gave exactly the same collateral that you were getting in the underlying transaction, there wouldn't actually be a trade there. There'd be no opportunity for anyone to make any money in that. Therefore, you wouldn't be doing that transaction. And as soon as you move away from the perfect replication of the constituent elements, you all of a sudden you're building in a tracking error to the transaction. So it could be closer correlation or it could be even further away. So by definition, the concept of perfect correlation just doesn't exist. And I think that's the challenge. So what you go back to is some of the underlying principles that ESMA was talking about in terms of liquidity, in terms of diversification, in terms of related assets, and that's where it's really adding value to make certain that, you know, those are the issues that people are concentrating on and disclosing to investors.
Okay, so I mean, it's just to summarize then, we as, you know, observers of this or people involved in this relatively the small sector of the funds business, small but growing sector, should be aware of all these other discussions that are going on, because they're going to impact business models if nothing else, and the structure of funds. I mean, Alain, what are your thoughts on what Roy has just mentioned?
Well, you know, the systemic risk discussions are very interesting. You remember it all began with the FSB report, where they mentioned synthetic ETFs, but they also mentioned securities lending as having some equivalent effect. It was not very much mentioned at that time. It has not been very much seen by journalists, but that was quite important. And with time, it seems that they are now focusing very much at world level. All world institutions are now looking at securities lending and collateral in general. This is a very big debate. And in fact, when you look at it, synthetic replication is only a variant of securities lending from a systemic risk standpoint. And it's quite small, you know, it's like 80 billion against 2,000 billion of securities lending. So the end result of all this is that now there is very much a scrutiny at a world level of securities lending operations, and it's not likely to stop. And the FSB, I understand that the FSB is very much looking at securities lending worldwide. Yeah.
But these are, I mean, more broadly, these are questions about the banking system as a whole, aren't they? These are, or about the financial system as a whole, because they're looking at liquidity transformation. It's not just lending; it's how the whole system operates, isn't it? That's what they're concerned about.
Yeah, and it's also being part of the reflections on shadow banking. You know, actually, securities lending is becoming part of a worldwide discussion of shadow banking.
Yeah. I'd like to ask you all to share your thoughts on the future of the ETF market in Europe, because that's the subject of our discussion. But just before we do that, I'd like to ask you, Alain, one point about tradability of ETFs, because that's one section of the ESMA paper that the regulators talked about requiring issuers to ensure that investors can redeem if market makers can't perform, or even to offer people a direct redemption option. How do you see that discussion evolving?
Well, I think it's fair. I think that I mean, this is the basics of a UCITS framework, that investors have the right to redeem their share at any time. So we welcome the idea that if, for example, there is no access, if a secondary market is not open anymore, investors have a right to redeem on the primary market. It seems to us very natural. And actually, in the prospectuses of our ETFs, there is already a clause like that. Whereas if the secondary market is not open for any reason, then investors have a right to redeem on the primary market.
But that could come with an extra cost. I mean, it might cost people a few percent to do it that way.
No, with a very limited cost. I think that most regulators anywhere will require such thing. I mean, if the secondary market doesn't allow investors to redeem, they should be allowed to redeem on the primary market. It seems to be very logical and a basic protection of investors.
Okay. Frédéric, let me turn to you. Our webinar is entitled ESMA and the Future of European ETFs. How do you see, in a very broad brush way, how do you see ETFs fitting into the future of the European funds business?
Well, a lot of the discussions on the risks of ETF arose from the idea that retail investors could be confused with new products available on the market. At the moment, the European ETF market is largely institutional, 90% perhaps, and the retail market is underdeveloped, not least because, well, distributors have been channeling investor funds into products that offer higher commissions than ETFs. But As you know, there are some initiatives at the country level, e.g. in the UK, or now the European level with MiFID, to bring more transparency on fees. And this would make ETFs very attractive to retail investors. So I think retailization is one area where we'll see development in the future.
Well, Roy, what's your take on the whole process and how ETFs will fit in future in the European funds business?
Well, I can't really speak from an investor point of view, but what I can say is that what we're trying to do with respect to these regulations and where it all fits in is to make certain that ETFs, which have been a growing and important influence in the market over here, remain competitive with their peer group of institutional investors, you know, in terms of the other pools of money. And so when we've been making comments here, whether it's irrespective again of whether it's a physical or synthetic or whatever, the reality is the risks are the same. I think the drive towards transparency and disclosure is generally a good thing, and that's generally the sort of thing that brings in more investment into the process. But what we need to do is make certain that there's a level playing field, not just within the UCITS community, but within the wider sort of pooled investment vehicles around the world. And I think what we have actually seen is that despite sort of the losses and the issues that have occurred in the market over the past few years, the reality is that where losses have been made, they've actually been very concentrated. And so in the context of where the FSB is actually looking at securities lending, as Alain mentioned, it's really more about cash reinvestment, rehypothecation, and less so about sort of the systemic risk issues per se, because they've actually been shown in probably the most difficult markets that we've seen that securities lending itself didn't bring systemic risk to the issue. So yes, FSB is interested in it, but it's a very narrow focus. And frankly, all of the regulatory inspection into securities lending, in fact, over the past sort of 3 years, has meant that we've actually had new participants, new supply coming into the market that didn't exist before, largely because regulators have gone in and said, actually, if it's prudently conducted, it's actually valuable to the market.
Oh, okay. And thank you, Roy. Alain, could you give some concluding thoughts on the future growth rates of ETFs in Europe and how this particular part of the market is going to develop?
Well, I think the important, I think the positive thing about what has happened concerning regulation of ETFs is that it has led to much more transparency, and this transparency obviously benefits very much investors. It has also allowed, I think, the market to understand better all ETFs, so I think it is very positive. And obviously ETFs are excellent products. The services that they provide are absolutely compelling. They allow any investor anywhere in the world to take an exposure on any type of market anywhere in the world and at very low cost, and that characteristics will lead them to continue to grow massively. So I think it's only the beginning of a nice story.
So you think that the slowdown in the growth rate in the market last year in Europe was just a temporary pause? Absolutely, definitely. Okay. Okay. Well, I'd like to thank all our panelists for sharing their views. I'd like to thank Lyxor for sponsoring the webinar, and I'd like to thank all our participants for listening in and for sending in questions. Thank you all very much.
Thank you.
Thank you.